What's going on, guys, and welcome back to another video. So in today's video we're going to talk all things dividend versus growth investing. We'll give examples of each of these types of investing. We'll give the pros and cons of each. We will look at my own portfolio on Trading212, and I'll go into the examples of dividend stocks and growth stocks that I hold. We will discuss how dividends versus growth stocks perform over the long term. And finally, I will give my recommendations and conclusions on what type of investing I feel is better in the long term. But again, as always, if you're new around here, please consider subscribing to this channel, as we're currently on 283 subscribers, so our next target is 300. So with that being said, let's dive right into today's video. I find that the Wall Street Mojo.com gives a good example of breaking down the difference between dividends versus growth. So they state, in the case of dividends, the excess return that is earned in a stock is declared and shared within the investors, and the excess profits are withdrawn only as dividends, whereas in the growth model, the excess return that is earned is reinvested and the profits are materialized only when the same are redeemed or sold. An example of a well-known dividend-paying company would be Coca-Cola with ticker symbol KO. We can see here from Dividend.com, a site that is brilliant for checking up companies' dividends and their frequencies. We can see here that the forward annualized dividend yield is $1.64 per share, which equates to 3.4%. We see here also the dividend frequency. Most companies, just like Coca-Cola, pay a quarterly dividend, so that 160 would be split up on a quarterly amount and paid on a quarterly basis. Another example of a dividend-paying company would be Johnson & Johnson, and we see here that their LTM dividend yield is $3.75 or 2.6%, and again it is paid on a quarterly basis. So a lot of people tend to invest in dividend stocks just to get the dividend payout, and again, if you only held one share or even a few shares in Johnson & Johnson, $3.75 a year wouldn't be a lot, but over the long term, once you begin to compound this dividend payouts, your yields and your return increase drastically over time, which is why a lot of people tend to stick just to dividends. And we can also see, if you look at dividends as well, you can see the aristocrats, and a lot of people just tend to invest in those. So we'll go through those quickly right now. So a lot of people tend to stick to dividend aristocrats as safe options when deciding on dividend companies to invest in. We can see here that a dividend aristocrat is a company in the S&P 500 that pays and increased its base dividend every year for at least 25 consecutive years. Now if you scroll down here, you can see numerous different sectors and companies that have dividends increasing over the last 25 years or more, and you can see such impressive ones here as Coca-Cola and 3M with a 57-year consecutive dividend growth. You have companies such as Johnson & Johnson, the healthcare sector. We even have PPG Industries and Materials, AbbVie and Healthcare, PepsiCo and Consumer Staples. We also have S&P Global in the financials. Utilities, we have the Consolidated Edison, to McDonald's and Consumer Discretionary, Walmart, ExxonMobil, AT&T, and the list goes on and on. So a lot of people stick to these companies as they will be deemed safe dividend companies over the long term. It is also worth noting that investing in dividend companies is definitely not a get-rich-quick scheme that a lot of growth or speculative stocks can offer. It takes years upon years to accumulate enough money in your investment portfolio to be able to live off dividends, with a lot of people aiming to get at least €1,000 or dollars in dividends every month. But I made a video a few months back which showed that you needed roughly around 400,000 invested in dividend companies to be able to make €1,000 or dollars a month on dividend payouts, which again is not realistic for the average investor to have 400,000 invested. But as you're thinking the long term, this compounding effect will definitely build up your portfolio over time. So examples of growth stocks would be companies such as Tesla, Facebook, Amazon, and even companies that are up and coming, such as in the electric vehicle sector as Workhorse. But for the purpose of this video, we'll just focus on the company Tesla, which the majority of the world knows about. So you can see here that unlike dividend stocks that would hover up and down 3 to 5% or even 10% annually at max, they don't really fluctuate too much. But in terms of growth stocks, they have the capacity to swing a lot more, both in an upward trajectory, and they can crash just as fast. So they're a lot more volatile and less safe than your standard dividend company. However, the risk reward ratio is a lot higher and you can gain a substantial amount more. So you can see even here from this time last year, Tesla was worth about $65.63, and they're currently up to $415 or $420 right now. So you can see the growth potential is much more extravagant than, let's say, a dividend stock such as Coca-Cola. Even just logging into my Trading212 portfolio, I got a notification that my Coca-Cola shares paid an ordinary dividend of 35 cents per share, which means I received 56 cents. Again, it doesn't seem like an awful lot. In fact, it's nothing at all. But when you gotta realize as well is that long term, if you reinvest this 56 cents, it has a compounding effect year in, year out when it gets paid 4 times a year. And as again, once you increase your stakes in these kind of companies as well, so will your dividend payouts. So it's definitely a long term kind of game. So even just to briefly look at my own portfolios and my pies on my Trading212, for example, in the communication services, we have Facebook, which would be classified as a growth stock, and in the same pie we have AT&T, which is a dividend stock. We can have the same across the board. Tesla growth, McDonald's would be a dividend paying stock. Again, in consumer staples, we would have Coca-Cola, which would be classified as one of the aristocrats in the dividend world. Same with PepsiCo and P&G. In energy, would be classified more as a dividend and growth stock actually, because they are quite a lot more volatile than, let's say, the Coca-Colas of the world, but they also play a quite nice dividend. Same with the ETFs, they'd be classified as a more safer option, as it's across the 500 companies in the US, the top 500. And again, this would be a mixture of dividend and growth companies as well, which I believe is definitely key to successful investing in the long term. We then have sectors such as the financial sector, which is predominantly kind of dividend paying, but we also have some growth sector companies here as well, such as Visa and MasterCard, and then the dividend ones would be JP Morgan, Bank of America, and Goldman Sachs. Healthcare, we have 3 dividend payers here as well in the form of Johnson & Johnson, AbbVie, and Pfizer. In industrials, again, dividend paying, 3M and Caterpillar. Materials, Barrick Gold. Real estate, we have another one, Realty Income, which pays a monthly dividend yield. In terms of tech, would definitely be more growth and dividend. And in tech, I have Microsoft, Amazon, Apple, and Alphabet. And again, they'd prefer to reinvest their money into the company to increase the share price instead of actually paying a dividend. We then have waste management, which pays a dividend also. And finally, it would be my YouTube pie. And these would all be growth stocks instead of dividends in the form of Workhorse, Virgin Galactic, Diamond Peak or Lawson Motors, and Neo Incorporated. Now, these would be all more speculative stocks, so they could peak in value drastically or they could also crash. Like you see here, for example, I only invested in Virgin Galactic a few days back and it's already up 11%. And on the other hand, you have Diamond Peak here, which is down nearly 10% at the time of recording. Again, another company that I just invested in a few days ago. So as this portfolio or this pie, YouTube pie, is definitely a lot more risky than, let's say, my financial pie. There's only a small amount of capital involved in this pie because of the volatility of it. But again, this would be more classified as a growth stock pie. So in terms of performance, dividend aristocrats definitely are more consistent over the long term. But again, because they aren't growth, they tend to only increase in value steadily, just like an ETF, maybe a bit better than an ETF, maybe 8 to 10% a year it will increase. So over the long term, these dividend aristocrats do increase your money and they certainly will make a profit over the long term if you're diversified across different sectors. Whereas with growth companies, you would also see that there is quite a lot of upside as well as downside in terms of volatility in these companies. So again, if you're kind of long-term investing and you have money to spare, then definitely some growth stocks would be definitely worthwhile to invest in. But you have to realize with growth stocks come a lot of risk as well as potential reward as well. So my own personal opinion is to invest in both dividend and growth stocks, like you can see throughout my own portfolio, that I mentioned many different dividend aristocrats as well as some blue chip growth stocks, as I feel it's once you have a good mixture and blend across all different sectors in the market. You can see I'm invested in all 11 sectors, and I also am invested in both dividend and growth stocks, so I feel I have the best of both worlds because I have a bit of risk in my portfolio and I also have safety in my portfolio. And I feel that because I'm in my 20s, I don't want to have complete safety in my portfolio either, as the return is going to be quite small over the years. So because I'm younger, I tend to need to have a little bit more risk in my portfolio, and I'm able to afford to do that because of my age. So I believe both having dividends and growth stocks in your portfolio, if you're under 40, is definitely vital to have a long-term profitable portfolio. So again, just using Tesla as an example, you can see here in a 5-year chart, so it went from like $44 a share, and you can see the drastic incline over the last few years. Whereas we can see with a dividend company such as Coca-Cola, over the last 5 years, it has only increased $7. So it went from $42 5 years ago and is currently $49. So only a $7 increase over 5 years, which is about $1.20 or 25 cents per year, which again is very little, but it's a very consistent stock and you can kind of sleep at night as well. It's not like, say, the Teslas of the world that could drop drastically overnight or increase drastically overnight for that matter. So with dividends, you have to realize well you get paid the dividends quarterly, so you're actually getting paid that way as well as the CGT, the capital gains. So you need to realize that it's a slow, steady growth, but again, once you keep adding shares and accumulating up a vast amount of shares in companies such as Coca-Cola, that over the long term, you'll definitely be making a lot of money. So, with all that being said, that brings the end to today's video. We went through and we discussed the difference between a dividend and growth stock. We gave examples of each. We looked at some pros and cons, and we also went into my own portfolio to see what growth and dividend stocks I'm invested in. We briefly discussed how these dividend versus growth stocks will perform over time when we looked at companies such as Coca-Cola and Tesla. And I also gave my recommendations of that I have both dividend and growth stocks throughout my portfolio, as I believe it's the best. Having the best of both worlds helps your portfolio in the long term. Again, if this video was any way helpful, I'd be really appreciative if you consider smashing that like button. And as always, if you're new around here, please consider subscribing to the channel and comment below if you have any questions, queries, or recommendations on anything got to do with growth or dividend stocks. Thanks very much, guys, and I'll see you all in the next video.